This is Nightly Business Report with Sue Herrera and Bill Griffin.
Here comes Amazon. The online retailer buys a little-known internet pharmacy, rattling parts of the traditional healthcare industry.
Nike's big run. Sales were strong in North America for the first time in a year as the Dow component turns in a better-than-expected quarter.
Place your bets. Atlantic City reopens 2 casinos, but will they improve the city's fortunes? Those stories and much more tonight on Nightly Business Report for this Thursday, June the 28th.
Good evening, everyone, and welcome. Amazon is making a big push into the pharmacy business. The online retailer is acquiring PillPack. It's an online pharmacy with a nationwide reach. It's exactly the type of move the healthcare industry has been fearing for some time. And that is because some see Amazon's entry as a way to upend the traditional market for prescription drugs. That sent shares of Walgreens, CVS, and Rite Aid sharply lower. It also pressured stocks in the drug distribution industry. Meg Terrell takes a look at whether Amazon just took its first step to becoming a major player in healthcare.
Amazon is the great disruptor. From books to retail to grocery stores, the entrance of Amazon has signaled massive transformation and loss of business for competitors in its path. For more than a year, it appeared pharmacies may be Amazon's next target. With its announced purchase of startup PillPack, the online giant has signaled a major move into the space. PillPack is a 5-year-old online pharmacy specializing in serving patients with multiple prescriptions. It delivers pre-sorted medications directly to patients' homes.
You'll never sort your pills, never stand in line at a pharmacy, and never miss your medication again.
It also allows patients to contact pharmacists at any time of day, online or through text messages. The company's not big. It had revenue of about $100 million in 2017 versus more than $50 billion for both CVS and Walgreens. Amazon is thought to have spent about $1 billion to acquire PillPack, though it didn't disclose the terms. But the market reaction was massive. Stocks of CVS, Walgreens, and Rite Aid all sank, erasing many billions of dollars in their market value. Drug distributors AmerisourceBergen, Cardinal Health, and McKesson and pharmacy benefit manager Express Scripts also saw shares decline. Walgreens has long been on the defense when it comes to Amazon, and its CEO struck the same tone today on its quarterly earnings call.
We don't see any reason to be worried. We are not complacent, I repeat this. We have a clear plan, and I believe that we will continue with the execution of our plan.
Others in the space have already turned to mergers to try to counteract the Amazon threat. CVS is attempting to purchase Aetna for $69 billion and Cigna to buy Express Scripts for $67 billion. And as analysts point out, it's not just the competition for pharmacy business that may be weighing on retailers.
When I go into CVS and Walmart, who's a loser here in this bidder, I'm picking up a lot of things on the way to getting my drug prescription at the back of the store. Now I'm definitely going to be doing all that online. So I think this just puts Amazon right in a great place.
And while Amazon's broader plans for the pharmacy space aren't immediately clear, investors clearly believe it'll disrupt here as much as it has other industries. For Nightly Business Report, I'm Meg Terrell.
Stephen Halper joins us now to talk about all of this. He is the managing director of equity research at Cantor Fitzgerald. Thanks for joining us tonight.
Oh, thank you for having me.
So last year, a little over a year ago, when Amazon bought Whole Foods, it sent huge ripples through the grocery business. With today's announcement about PillPack, do you see the same thing happening in healthcare?
No, I think the pharmacy business is a lot more complicated than grocery, simply because the employers as well as the pharmacy benefit managers get to control the networks where consumers can get their prescriptions filled. Most of the managed care companies in our universe that we cover at Cantor already have captive mail order facilities, and they basically exclude other mail order facilities. So you can't get your prescription filled at another mail order pharmacy.
So what is it for Amazon? Why would they do this then if what you laid out, obviously, kind of shrinks the market for them?
Well, clearly, pharmacy is a very large market, and to some extent, perhaps the next move for Amazon is to move into the pharmacy benefit space. That's a possibility. There are also many small payers health plans that don't have captive mail order, where this might be a good service. But remember, pharmacy is a very large industry, collectively $360 billion of sales, and PillPack is very small, and there's a very long road to climb here to really become mainstream. And the biggest challenge is being part of the pharmacy networks. Many years ago, there was a company, drugstore.com, that tried to do the same thing.
Right.
It simply didn't work.
Clearly today we saw a big response to all this. Sue is showing those fellow drug distributors and retail pharmacies that saw big declines in their stocks after this announcement came out. The same thing happened last year on the Whole Foods deal. A lot of grocery stocks went down, but then they came back. Do you see the same thing happening here? In other words, would you be stepping in on some of these pharmacies right now?
Right. So, within my coverage list, which is the managed care list, we saw the same weakness because of the exposure to mail order pharmacy. We believe that the stocks overreacted, and we would certainly reiterate our overweight rating. Within our coverage list, we would point out United Healthcare and Centene as two great managed care companies, followed up by Anthem, which is actually going through a process to insource its PBM and its mail order pharmacies, and they're actually going to be partnering with CVS beginning in 2020.
Very good. Stephen Halper with Cantor Fitzgerald again. Thank you for joining us tonight.
Thank you.
Well, Amazon's move into the drugstore business came on the same day Walgreens posted its first earnings report as a Dow component. The company topped Wall Street earnings and profit estimates. It hiked its dividend, and it's buying back shares. But as Kate Rogers reports, Walgreens is facing a number of challenges.
The newest blue chip is feeling blue. The nation's largest drugstore chain is facing new competition from Amazon and trying to compensate for some of its own missteps. Same-store sales in Walgreens' retail division were down as people spend less on household and personal care items. Even its pharmacy business was flat.
The same-store sales, especially in the U.S., were quite weak, and that just reflects what we've been seeing in the channel for the last couple of years, which is margin pressure coming from both ends of the business.
Analysts say the company is aiming to position itself as a health destination like some of its competitors, offering an array of services designed to bring in customers. Last year, the company announced a partnership with FedEx for drop-off and pickup services, as well as a partnership with LabCorp for patient service centers, which are showing some promise with early openings in Florida performing well.
They've mentioned that they're doing optical and hearing. So I do think that they're kind of inching toward doing more healthcare type services and chasing CVS.
The good news for investors came today in the form of a $10 billion share buyback and a higher dividend. And Walgreens does have another thing working in its favor, demographics. As boomers continue to age, they're likely to fill more prescriptions. For Nightly Business Report, I'm Kate Rogers.
Elsewhere, fellow Dow component Nike reported better than expected earnings and revenue thanks to a number of new product launches that consumers liked. Nike earned 69 cents a share. That was 5 cents better than estimates. Revenue rose nearly 13% to more than $9 billion. And that obviously pleased investors. They sent the stock higher in initial after-hours trading. Sarah Eisen now has more details on Nike's quarterly results.
Nike just did it again, beating Wall Street's high expectations in its quarterly earnings report. 3 takeaways. North America is growing again. This was one of the biggest questions going into the report after a sluggish period in Nike's home market, an important market. North America, representing more than 40% of total Nike sales, is now growing again, 3%. Investors want to hear if that can continue. Nike's growth market continues to be on fire. That would be China. China representing 35% revenue growth for Nike during the quarter. One question, though, will the trade headwinds, if they escalate, start to hurt? It's not only an important market in terms of customers for Nike, as seen by the growth during this quarter, but for manufacturing as well. Footwear and apparel so far have been spared from the tariffs back and forth between the U.S. and China, but if things get worse, that could be an issue. And finally, in terms of products, basketball continues to be hot, but the Jordan brand, not so much. Jordan brand sales shrinking during the period on lower volumes and sales But basketball is still continuing double-digit growth. New styles like Vapor Max and Epic React, analysts say, are performing very well. Overall, a healthy snapshot on what was already one of the Dow Jones Industrial's best winners of 2018. For Nightly Business Report, I'm Sarah Eisen.
On Wall Street, stocks rose as investors brushed off the uncertainty over trade policy. A rally in the technology and financial sectors helped lift the major averages. And by the close, the Dow Jones Industrial Average advanced 98 points to 24,216. The Nasdaq was up 58, and the S&P 500 added 16. Bob Pisani has more on today's move higher.
Stocks ended in the green after a slow but steady drift higher. And with just one more trading day left in the month, the Dow is on pace to end down about 0.5% for the month of June. The market showed some signs of relief in the rare absence of any trade-related headlines. Industrial stocks and material stocks, which have been hit hard by trade-related concerns, managed to eke out small gains. Tech and financial stocks provided a big help for a change. Goldman Sachs, JP Morgan, Citigroup, Morgan Stanley, all up more than 1%. In fact, the XLF, it's a basket of financial stocks, finally managed to snap a 13-day losing streak as the Federal Reserve released the results of its latest round of bank stress tests. Now remember, tech and financials are the two largest sectors in the S&P 500. They've been massively oversold for months. Semiconductors, in particular, have been very oversold. But for the year, the S&P 500 is up just about 1.5%. Its worst first-half showing since 2015, believe it or not. Sectors that led the charts through most of the quarter have weakened as the second quarter has come to a close. So that's sectors like small-cap stocks, the Russell 2000, the FANG stocks like Facebook, Apple, Netflix, and semiconductors. But there's still a lot of good news out there for the second half. Buybacks are at a record and showing no signs of slowing down. Tax cuts are continuing to boost U.S. earnings. U.S. growth is strong. The markets have been shrugging off a slight downward revision to first quarter GDP today. So the waters, the problem is, are just a little bit muddier right now. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
It is time to take a look at some of today's upgrades and downgrades. IBM was given a rating of buy in new coverage at Nomura Instinet. The analyst cites the potential for modest but sustained revenue growth. The price target is $150. Shares of IBM rose nearly 2% to $140.04. Salesforce is rated a top pick by BMO Capital. The analyst cites the potential for Salesforce to expand its operating margins. The price target is $152. Shares of Salesforce rose more than 1% to $135.12.
Meanwhile, Mattel was downgraded to underperform from neutral at D.A. Davidson. The analyst cited valuation, and it's lowering its earnings estimates for the toy maker. Price target now $12. That stock fell more than 2.5% to $16.34. Madison Square Garden was upgraded to buy from hold at Jefferies. The analyst cited the company's just board-approved plan to spin off its sports businesses into a separate company. Price target now $350, and that stock soared nearly 14% today to $303.29.
Still ahead, the financial sector moved higher today after floundering for a while. Is that a positive sign for long-term investors?
Amazon certainly was busy today. In addition to that pill pack deal we told you about earlier, the company made another move as well. Amazon announced it is rolling out a new delivery service aimed at that most critical part of the delivery chain, the last mile. Logistics, of course, has been a big part of Amazon's success, and now the company is ramping up its own network. Courtney Reagan is at Amazon headquarters in Seattle.
For FedEx, UPS, DHL, and the Postal Service, a major customer becomes a bigger competitor. Today, Amazon is launching a delivery service, hiring hundreds of delivery service partners, individuals running their own local Amazon package network. By doing this, Amazon is hoping to tackle the final, most expensive leg of shipping a package, called the last mile. Amazon will lease up to 40 logoed vehicles to each unit and provide training and technology. Each business will start the day at one of 75 current Amazon delivery stations in the U.S., getting their packages and routes. Ola Abimbola has been running his Amazon delivery service for 5 months as part of a test in Denver.
Start the background, the back-end process, which is making sure we get ready for the day, making sure the drivers are assigned the right area to deliver in, making sure that the packages are ready, work with the station that we operate out of.
Amazon algorithms, built to maximize efficiency, determine which packages will go to Amazon's new local delivery network and which go to other delivery partners like FedEx and the Postal Service.
This is all about scaling cost effectively. If you think about the growth of e-commerce, growth of parcel delivery in general, we're going to have to meet this growth. It is outpacing the growth of our core providers.
Amazon is now represents half of the e-commerce area, which is only 15% of total commerce. So if it's going to go to 40 or 50% of commerce, they're going to have to increase their logistics capability by 3 or 4x. And UPS and FedEx basically can't do that. And so Amazon has to find some new ways to continue to grow their logistics capability.
In response to Amazon's new delivery program, UPS says it closely monitors customer and competitor announcements. The Postal Service says it needs to earn its customers' business every day. Amazon is hoping this new program will help it cut costs. For Amazon's partners, it's both an opportunity and a risk. An opportunity to start a business with Amazon's help, but a risk to run a business completely dependent on one customer. For Nightly Business Report, I'm Courtney Reagan at Amazon headquarters in Seattle, Washington.
Meantime, the economy grew less than initially thought in the first quarter. The gross domestic product was revised down to 2% amid the weakest consumer spending in 5 years. Economists, however, are expecting a rebound in the second quarter.
Now, as Bob told you earlier, the Federal Reserve today cleared the way for most of the biggest U.S. banks to return billions of dollars to shareholders. The one exception was Deutsche Bank. Regulators cited material weakness in its data capabilities and capital planning controls, so that rejection now requires Deutsche Bank to make changes in its U.S. operations. But for all the other banks, they immediately came out with dividend hikes and buyback plans. Even Goldman Sachs and Morgan Stanley were allowed limited payouts. Here are some of the new dividend plans, and then here are some of the buyback plans that were announced late today.
Well, obviously, a positive day for the financial sector after suffering its longest losing streak ever. The XLF, which is an ETF that tracks the financial sector, rose today after falling for 13 straight sessions. But will the gains hold? Ken Leon is the Global Director of Equity Research at CFRA Research, and he joins us now with his outlook. Good to see you, Ken. Welcome.
Welcome. Thank you.
Bill just detailed the stress test results, and they were positive for many of those banks. Did what we see today form a bottom, do you think, in the financial sector?
I think it did. And for particularly the large banks, return of capital, dividend increases, and share repurchases looks like it's set to reward investors. We think that's a key driver for the second half of this year. There's other drivers in the business that are healthy, and there's been some concerns as well.
But I'm curious, I mean, the economy is clearly in good shape right now. Interest rates are going up. Both of those things are good for the banking sector. They improve their profitability, and yet their stocks have been in this prolonged slump. Why is that, do you think?
The stocks had great performance last year, and they did stall early this year. I think the concern is, with the economy being so strong, loan growth is still, for example, on the corporate side, 2%. Why isn't it 4 to 5%? The consumer side loan growth is better. And then you often hear about a flattening yield curve. Banks need a healthy spread between the cost of their money and what they lend for as well.
All right, so if you were to put new cash to work in these names, what names do you like in the financial sector?
Well, taking into account today's news from the Fed, Bank of America, which is a strong buy, is going to have meaningful return, 40% upside as it relates to buybacks and dividend growth. They also are executing very well every quarter now. JP Morgan's the quality large cap name. They also had very positive news as related to a dividend increase. And then thirdly, still like the capital markets, and we prefer Morgan Stanley which is a buy. Morgan Stanley is going to be a big beneficiary for mergers and acquisitions and investment banking.
All right, Ken, thank you so much. Appreciate it. Ken Leon with CFRA Research. Bill?
Shares of BJ's Wholesale soar on their first day of trading, and that's where we begin tonight's market focus. The members-only wholesaler made its return to Wall Street after 7 years as a privately held company, and its debut comes at a time when the entire industry is facing stiff competition online.
I think any retailer who says that they don't compete with Amazon isn't being truthful. So there is no doubt that the consumer is getting great value and great convenience. But in the world we're living in today, value retail works, and membership on top of value retail is a business we feel great about, and investors have been encouraging us along the way.
And they did today. Shares of BJ's rose nearly 30% in its debut to $22 even. Meanwhile, the long-running patent dispute between Apple and Samsung is finally over. 7 years after it began, the two companies settled their litigation over smartphone technology. Terms of the settlement were not disclosed. You may recall that Apple had accused Samsung of copying iPhone design and software features. Apple shares were up about 0.75% today to $185.50.
Chipotle's CEO outlined a broad strategy to revitalize the restaurant chain, which includes closing 65 stores and spending more than $100 million to win back customers. But the plan was light on details, and that disappointed investors. Shares fell 6% to $428.36. McCormick reports savory second quarter results. The spice maker posted double-digit sales growth and profit thanks to strong demand from both its consumer and commercial customers. McCormick shares rose more than 8% to $114.83, their best day in nearly a decade, and a new high as well.
Coming up, rolling the dice on Atlantic City.
Two brand new casinos opening up on Atlantic City's boardwalk, which has been a little down on its luck. Is it enough to help the city regain its status as the crown jewel on the Jersey Shore? I'm Contessa Brewer. That's coming up on Nightly Business Report.
Casino investors are betting Atlantic City is about to have a change of fortune, with two new casinos opening this week. In recent years, the city saw casinos close and AC pushed to the brink of bankruptcy. But now, as Contessa Brewer tells us, the city is raising the ante that good times will roll once again.
With a guitar smashing and a ribbon cutting, two new casinos opened on the famed Atlantic City boardwalk. Mayor Frank Gilliam hopes it's a turning point for his hometown.
For so many years, the community was actually left aside. But my job this year and this term is to make sure we develop that partnership between corporations and the neighborhoods.
Kenny Parnell has worked in Atlantic City for more than 30 years, but he got his walking papers from Trump Taj Mahal when this town hit the skids.
Leading up to the moment of actually being dismissed, I leave here now tired, working 14-hour, 15-hour days, and I walk out smiling. Compared to the experience I was waiting for the hammer to drop, it's a lot of stress.
In the mid-2000s, casinos in New York, Pennsylvania, Delaware, and Connecticut created stiff competition for gamblers. Gaming revenue in Atlantic City fell by 50%. Nearly half the casinos went belly up. 11,000 people lost their jobs. The city's finances were in such bad shape the state took over. But that created an opportunity for a real deal. Hard Rock bought the former Trump Taj Mahal for 4 cents on the dollar of the original construction costs, but are spending a fortune to draw top talent to their stages, with some 300 acts already booked for the first year.
Now we're over 300 shows with a complete variety of entertainment, whether it's comedy, Motown, obviously the legendary Pitbull, Carrie Underwood tonight or tomorrow night playing. So just a really great array of Broadway entertainment, restaurant, shopping. That's what people want to see. And we're delivering it not just here at Hard Rock, in Atlantic City.
My hope is now that as we open and the Hard Rock opens,
that the entire boardwalk is activated. And the 24.5 million visitors that come to Atlantic City realize, wow, this is an incredible place.
Sports betting, newly legalized, is already a big draw.
Browns to win 5.5 or more games.
And gaming revenues have turned a corner, climbing modestly for each of the last 2 years.
Gaming analysts are skeptical that it's a clear-cut jackpot. Investors are counting on convention business to fill these hotels midweek. But adding 3,000 hotel rooms creates tough competition for the existing resorts, especially in the winter months when visitors are scarce.
Add in the vacant lots, boarded up windows, and decrepit buildings still dotting the landscape, it may be a hard sell.
We have a very aggressive code enforcement process that we're putting in play to get rid of abandonment and dilapidation, because we realize the imagery of Atlantic City hasn't always been the best, but it's our job to change that perspective as we grow.
The mayor says his 7-year plan includes technology, alternative energy, a new college. The big question, will investors have the patience to let it ride? In Atlantic City, Contessa Brewer, Nightly Business Report.
And before we go, a final look at the day on Wall Street. One of those days where we saw the opposite of yesterday. Yesterday, technology and financial stocks were the big losers. Today, they were the big winners. And the Dow advanced by 98 points to 24,216. Tech-led NASDAQ was up 58 points, and the S&P gained 16 points in today's trading.
And that will do it for Nightly Business Report tonight. I'm Sue Herrera. Thanks for watching.
I'm Bill Griffith. Have a great evening. We'll see you tomorrow.